The Reserve Bank has kept its official interest rate on hold, despite indications the economy slowed sharply over the June quarter. The RBA board decided not to move, having made consecutive cuts in June and July to reach the historic low of 1%. The decision comes ahead of the release of second quarter GDP figures tomorrow, which are expected to show the economy has slowed to its weakest growth in almost 2 decades. And to take us through the RBA decision and the state of the Australian economy, we're joined now by Felicity Emmett, a senior economist at ANZ. Good afternoon to you, Felicity. The RBA chief had indicated just last week that interest rates are still heading down. What stopped the central bank from moving this month?
Look, I think they really do want to wait and see for a little while. Philip Lowe, at his testimony last month, said that they wanted to see an accumulation of additional evidence around the economy and what's happening. And I think that they're aware that while the growth numbers at the moment look really quite weak, that they know there's stimulus coming through in the form of tax cuts and the impact of the interest rate cuts. So they want to have a little further wait to see what impact that stimulus might have on the economy.
Tomorrow's GDP figures are going to come out. What do you think that will reveal?
Look, I think they'll show the economy is quite weak. We're expecting quarterly growth of 0.5. That would see annual growth dip to 1.4%, which is the slowest or equal slowest since 2009, and then prior to that, not since the beginning of this century. But importantly, the detail of that is quite weak. Private demand, we expect, will be falling. It's only the spending in the public sector that's keeping GDP positive, and I don't think that's a very good outlook. It's not a good situation for the RBA, and I think they'll be quite concerned about the momentum in the economy.
Talk us through today's release of the current account data, which showed a huge surplus, surprising many observers. Is this a good story or a mixed one, just showing how much domestic consumption is indeed falling?
Look, I think on balance it really is a good story. We're running very large trade surpluses. We actually had a narrowing in our income deficit. It means that we're requiring less funding from offshore. It means that, longer term our foreign debt will grow more slowly. So I think that is a good thing. But yes, part of the reason that was so large was because imports were weak. And that is generally not a good sign, and that is reflective of weak demand in our economy, both from consumers and from businesses.
What chance is there that Australia will enter a recession?
Look, I don't think that you can play totally down the chance of a recession, and often economists are not very good at picking when you're actually in one. But I think when we look at the stimulus coming through in the second half of the year, I think that will really help to keep growth supported. I don't think it will be strong enough to stop the RBA moving again, and I don't think it will be strong enough to stop calls for more support from the government, but I think it's enough to muddle through. So I think there is a chance that we go into recession, but it's really quite low. I would put it below 20%.
Does it really depend on what people do with those tax cuts once they receive them?
Absolutely. We are expecting that most of those tax cuts are spent. They are directed towards low and middle income earners, so it is most likely that people will spend those. The problem is, though, that the underlying momentum in consumer spending is really quite slow. We saw that in the retail sales numbers today, down 0.1% for July. So consumers are really feeling the heat from ongoing low wages growth and very high household debt. And I don't think the tax cuts will change that materially, although in the short term it will give some sort of sugar hit to spending.
Do you think the government is going to have to provide some other kind of stimulus, for instance, start to really spend up on capital infrastructure?
I think there will continue to be that pressure, yes. I think when we look around the world, monetary policy has done as much almost as it can do, and certainly the Governor of the Reserve Bank is calling for the government to do more. I mean, the numbers in the GDP report suggest the public sector is the primary driver of growth at the moment. So the government is spending at the moment, but there are other things that they could do in terms of further bringing forward tax cuts, increasing New Start, for example. Those sorts of things would flow through to spending quite quickly and help to support the economy. Infrastructure spending or other sorts of productivity enhancing reforms would also be helpful, but they are really long-term drivers of growth. They're not the sort of thing that we need, that will come into effect in the next year or so.
If the government was to really boost its spending in the short term, would that guarantee that recession is no longer a risk? Or is it simply pushing off economic problems a little further down the track?
Look, I don't think that government spending would be pushing off economic problems. The government's fiscal accounts are really in very good shape. We're likely to report a surplus for this year. We have low public debt. So I don't think that we have a problem with unsustainable government finances. So I think some stimulus in the coming year would be appropriate and not putting us in an unsustainable position down the track. I think the unsustainability probably comes from continuing to lower interest rates and pumping up through the economy through excess debt, and that would not be helpful in a longer term situation.
Just finally, one more question. Are you concerned that the Australian housing sector is again potentially approaching bubble territory?
Well, certainly the rise in prices in August was quite strong, and if we extrapolated that out for a year, that would certainly put it back in bubble territory. I think though we're seeing a little bit of catch up, volumes are still relatively low, but it's something that we and the RBA will be watching very closely to see whether we see a continuation of those price gains and whether that's matched by increasing debt, and that's when it would become problematic. But we really need to see a few more months of data to be confident about what's happening in the housing market.